I'm Joanna Simpson here at RiskMinds International in Barcelona. Joining me now is Daniel Mikkelsen, Senior Partner at McKinsey Company. Thank you very much for joining me.
Thank you.
And just tell me, how does it feel to be here at RiskMinds International?
It feels good to be back. Things are back to normal. I was here last year as well, so there was all the COVID testing and all the rest of it as well, so it didn't feel like we were quite back to normal, but this feels more like what it was like before.
Yes, it's nice to be back to normal now, isn't it? Yeah. Big change. And for those of us less familiar with the concepts of net zero target setting and portfolio alignment, would you explain what it is and why it's important?
Sure. So net zero target setting is the exercise of setting targets for financial institutions that are consistent with getting to net zero greenhouse gas emissions by 2050. Why do we need to get to net zero by 2050? Well, that's a target that's been set in order to keep temperatures, global temperatures, below 1.5 degrees above pre-industrial temperatures. And the 1.5 degrees is important because it's the level at which a lot of the more catastrophic outcomes of climate change can be avoided. So there's a direct sort of link from the climate science back through to the sort of targets that financial institutions are setting. And that's really what the exercise is all about. Now, to underpin the target setting exercise, various different alliances have been created among financial institutions. The most well-known to bankers is probably the Net Zero Banking Alliance, NZBA, which kicked off with 40-odd members in April 2021, has got more than 110 members now, so it's grown a lot in the meantime. And that is the alliance of those banks that have signed up publicly to achieving net zero and setting targets accordingly.
And you've actually mentioned some of this already, but how are banks tackling this and where are they on this journey?
Yeah, so it's important to mention that not only are banks setting targets for 2050, but as part of their NZBA commitments, they're also setting targets for the nearer term, most notably 2030. So that's really what a lot of the focus is on at the moment, is setting those targets by sector for 2030, which is only 7-8 years away. And so the way they're doing it is they're looking at what their current baseline of emissions financing looks like, and then they're comparing that against what the trajectory is that they need to be on in order to be consistent with achieving 1.5 degrees. So that's really what the exercise is about. In terms of where they are in the process, those banks that were the first 40-odd that signed up in April 2021, they're following a timeline that's really mandated by the NZBA. So they needed to publish their first set of targets actually by last month, and the full suite of targets for 11 critical sectors by April 2024, that would be, so 3 years after signing up. The same sort of timelines apply to other signatories, but those that have signed up later, the 70-odd banks that have signed up after April 2021, the sort of 18 and 36-month timelines then start from the point at which they signed up. And it's a pretty good description, really, of where banks are in the process. Depending on when they signed up, that's also sort of can tell you in rough terms where they are along the process, really.
And now that banks have set these targets, what are the main lessons that they've learned so far?
I would say there are quite a few, but I would say one of the key lessons is that, in a way, I like to say we're building the plane while flying it. So the standards that banks need to follow in order to set the targets are still being developed as those targets are being calculated and set. And there are a number of different standard setting bodies that banks refer to. For example, UNIP-FI have guidelines out, TCFD have worked on guidance, SBTI also have requirements. And the unfortunate thing, if you like, is that sometimes those guidelines are not consistent. So banks are navigating a bit of a minefield of determining, what sort of requirements to follow and how to, as I say, how to navigate that minefield. So there's one lesson about sort of being pragmatic with regard to how you navigate that almost invariably. I'd say the second lesson is around disclosure and data. So there's an increasing amount of focus on these sorts of public disclosures around emissions and around sustainability. There's also more and more requirements that are coming out from regulators. So European banking authorities, ITS requirements, there's the SEC disclosure requirements, which came out recently. So there's an ever increasing set of requirements that are coming out from a disclosure perspective, and there's a lot of attention being paid to it. At the same time, the data that underpins a lot of these exercises is, well, poor, or a challenge, choose your word. Banks are having to stitch together different internal data sources with a bunch of external data as well. And it's often a really big challenge, which is one of the reasons why you'll hear people, whenever they're asked about this, one of the first things they mention as a challenge is data. And it really is true. It takes so much time and effort. I think another lesson learned would be to keep the business heavily involved. I've seen quite a few banks that have set targets where it's been more of a, let's say, academic exercise. It's been more driven out of the functions, risk, sustainability, finance. The businesses are the ones who are going to have to deliver these targets ultimately, and it's important that they are bought in. I think there's also just pragmatic reasons for making sure that they're involved. Often they know the customers better, they know the data better, etc. So having the businesses really involved and bought in, I think, is absolutely key. So I think those are some of the key sort of lessons learned off the top of my head. There are many others, but those are some of the key things that I think are important. Perhaps one more as I think about it. I think the other thing, and it follows on from what I said before, is having a clear strategy as an institution for how you're going to achieve the 2030 targets. So imagine you've set a whole bunch of sectoral targets by 2030. It's very important that there's alignment within the organization about how you're going to get to those targets. Now, that plan needs to be flexible. We've seen all the disruption in the last year, Ukraine and energy crisis and all the rest of it. But I think quite a lot of banks don't really have that, that plan, that flexible plan for how to get there. And I think that's important. And then perhaps one last thing, and then I'll stop, is making sure that the targets that are set are embedded in the way that the bank is run. It's what we call operationalization or embedding. So making sure that it's embedded in financial planning, in target setting, in portfolio management, in deal approval and underwriting. And my very strong sense from having worked with and engaged with a lot of banks around this is that we still have a lot further to go on that front. So it's really early days with regard to operationalization. Those are sort of 5 lessons.
And just to pick up on that point, once net zero targets have been set, how can banks make sure that they achieve their objectives?
Yeah, so that follows on a bit from this idea of having a flexible plan, making sure the business is involved and that the targets are embedded in how the bank is run. In concrete terms, there are a number of levers that banks can pull. One is just to engage with their customers and their clients around green transition. That's really also the big hope from all of these banking alliances and all the rest of it. We want banks to engage with customers to help them transition to lower greenhouse gas intensity. That's going to be absolutely critical for the world to get to net zero. And if banks just stop financing the heavy polluters, then we're going to get a chaotic and disorderly outcome. So lever 1, which is absolutely the desired outcome, is engaging with customers, including the ones in heavily polluting sectors, to help them transition to greener modes of production or operation. There are a number of other levers. One is growing new businesses and new product propositions and advisory propositions and so on. So growing new green businesses. This isn't only, one of the questions I get asked a lot is this just, does this just require you to take a sort of discount on your normal pricing to get more green business done? That is absolutely not the case. I see many examples of banks actually growing completely new businesses and actually making more money and having happier customers by going down this route. And that takes me on to another lever, which is pricing. So starting to differentiate more between green and brown in terms of how you price. It's not so much of that happening yet, but I think that will come more and more. And then as a final resort, in my sort of prioritization of things, ultimately, of course, banks have the option to reallocate capital away from those counterparties who perhaps are not doing as much the transition as they need to do. But I'd emphasize again that, in my view at least, is a last resort. That is not where banks should be going first. That's not the intention behind all of this. It's probably also worth saying that whilst I've just emphasized all the things that banks can do in all of this, they are very heavily dependent on policymakers and regulators and society at large to deliver all of the targets that have been set, whether it be in agriculture or in housing, retrofitting, all of these sorts of things in transitioning industry, because ultimately the banks can't achieve those targets on their own. They're really dependent on the policy frameworks and the incentives in the wider economy being there to make that happen, if you see what I mean.
So it's a team effort.
It is, absolutely.
Daniel Mikkelsen, thank you very much for your time.
Very good, thank you.